Welcome to the deep dive. Today, we're doing something a bit different. We're skipping all the prepared stuff, the executive summaries, the press releases.
Right. We're bypassing the carefully crafted remarks because, let's be honest, the real strategy often comes out when executives are, put on the spot by investors.
Exactly. So we are diving exclusively into the Q&A session from the Q3 2025 earnings conference call.
This is where you find the unvarnished truth, really. Market weaknesses, competitive threats, and crucially, where the company is actually putting its money for the future. Think protein supply chains, finishing that big system restructure.
That's our mission today. Hunt for those strategic nuggets. Find out what management really prioritizes.
Okay, so let's start with how the quarter actually played out. There was this interesting point raised right away.
Yeah, an investor pointed out that July and August felt, well, slow. But then September saw this clear pickup in performance. So the big question was, did the market suddenly get better?
And their answer was key, wasn't it? They were pretty definitive that no, the external environment did not change. Absolutely not. They were crystal clear. The improvement wasn't some lucky break or a tailwind. It was manufactured internally.
Manufactured how?
They said the system was doubling down, specifically more marketing, more focus, pushing innovation harder, and really working closely with their bottlers on things like affordability and smart revenue management.
Okay, so this isn't a story about the market saving them. It's about their own execution, their own internal efforts making the difference. That feels more sustainable, doesn't it? Less reliant on the wider economy.
Precisely. And, that really sets the stage for Q4. They're basically saying the environment probably won't change much.
So it's all on them again.
It's all on execution through the holidays. They mentioned specific investments in programs, from Halloween right through Christmas, big push.
But they did flag something about volume, didn't they? They used that phrase, cycling a steeper comparison versus last year. Can you just quickly break that down for us? Does that mean they expect volume growth to be harder?
Yeah, it's that classic corporate speak, but it's important. It just means Q4 last year was really, really strong, like unusually good.
A high bar to clear.
Exactly. So beating or even matching that performance this year is just mathematically harder than if last year had been, average. It's a heads up that the year-over-year numbers might look a bit modest, even if they execute well.
Got it. Okay. And looking further out to 2026, they talked about inflation maybe easing off. How does that change their pricing strategy?
Well, they expect pricing to normalize, sort of settle back towards their long-term goal.
I see.
That balanced growth model, aim for, say, 2 to 3% volume growth, plus another 2 to 3% from price and mix. That gets them to their target 4 to 6% top-line growth. It's about growing the consumer base and earning the right price through value.
Okay, let's shift from internal stuff to the outside world. Competition. Investors asked about that, and the executives confirmed things are changing. Something about a swing towards local players.
Yeah, that was interesting. They noted a big overall shift to a little more localness, as they put it, and more regional variation. It's not just about price either.
What's driving that?
They think it's a bit like a pendulum. Things were quite globally similar during COVID and the big inflation wave. Now, different parts of the world are moving at different speeds again, so competition becomes more localized.
So if the market's fragmenting like that, a one-size-fits-all global campaign won't cut it. What's their response?
Push resources closer to the front line. That was their answer. Give local teams more power and insight to react differently in different places. They use the word intimacy in execution, knowing what works in, say, a specific neighborhood in Brazil versus a city in Europe.
Okay, let's zoom in on one of those regions. Latin America, Brazil, Colombia, Chile seem okay, but Mexico keeps coming up as a challenge.
Right. Mexico's the one where they keep needing to step in because the economy's been softer for a while. They said things are gradually improving, but getting back to really strong growth will take a little bit more time, managing expectations there.
And they definitely need to manage expectations because there's a big policy issue looming in Mexico, right? A new sugary drink tax increase coming January 1st, 2026.
Yeah, that's a significant headwind they're bracing for. Their plan is basically work super closely with the bottlers to adapt. They sounded, cautiously optimistic, referencing how they handled a similar tax back in 2014.
They mentioned recovering using RGM technology, revenue growth management. That sounds like the secret sauce. What does that actually look like on the ground in Mexico when a tax hits?
Yeah, RGM is basically their toolkit for smart pricing and packaging. So when a tax comes in, the RGM models help them figure out almost instantly, okay, which stores or channels can handle a price increase.
Okay.
Which bottle sizes maybe need to shrink a tiny bit to keep an affordable price point for people watching their budgets? Where can we push a new zero sugar version that avoids the tax altogether? It lets them react really fast.
That speed must be critical. It's amazing how much regulation they have to bake into their plans. And that kind of consumer pressure isn't just in Mexico, is it? Europe saw volume dip, and the reason sounded familiar.
Very familiar. Yes, volume was down in Europe, partly due to those tough comparisons we talked about, but also consumer behavior. They said the higher income consumers are doing fine, in good shape.
But the lower end,
But the bottom end is feeling the pinch, really feeling squeezed financially.
which leads to that value-seeking behavior they mentioned.
Exactly. People shopping around more, looking for deals, maybe switching to store brands or different package sizes. It just underlines why that localized RGM approach is so important everywhere. You have to offer affordable options or you lose those consumers.
Okay, let's pivot to the company's structure itself. That huge refranchising strategy they started way back in 2015. Sounds like they're finally nearing the finish line.
Yeah, this is a really big deal for them. They highlighted the last two large pieces falling into place. One is selling a big chunk of their Indian bottler stake to the Jubilant Barta Group.
And the other?
The other is Hellenic, their European partner, announcing plans to buy a controlling stake in CCBA, that's Coca-Cola Beverages Africa. Big moves.
So once those deals are done, what's left? Is that basically it?
Pretty much. They said only a handful of smaller countries are left, mentioning Malaysia and Singapore specifically. So yeah, they're entering a new phase, focusing almost entirely on brands, innovation, and managing the system rather than owning the bottling plants themselves.
And that shift has obviously helped their margins. They
Yeah.
talked about a big jump in operating margins since 2017.
Huge jump. It was 26.5% back in 2017. They said the expansion comes from that refranchising, sure, but also just a relentless focus on productivity. Supply chain efficiencies, managing costs tightly, making sure ad spending is effective. It's about funding future growth by being lean now.
Right. That focus on the portfolio brings us to Costa Coffee, the acquisition that maybe hasn't quite delivered what they hoped. They called it the coffee conundrum. What's the issue?
Well, the core Costa business itself, the coffee shops in the UK, that's doing okay. It's back to volume growth. They're reinvesting in stores. Costa Express machines are expanding. The category is great, big, profitable, growing.
So what's the conundrum?
The original reason for buying Costa, the big idea, was to massively grow the non-retail side through the Coke bottling system. Think ready-to-drink Costa coffees everywhere.
And that hasn't happened.
They basically admitted in the Q&A, we have not found a path to that. So now they're, in their words, standing back and reflecting on what to do next.
Standing back and reflecting. That sounds like code for a potential rethink. Maybe even a sale down the line. Or just searching for a new plan.
Well, they didn't say divestment, but yeah, when a company admits the core rationale for a major buy hasn't panned out, you have to assume all options are being considered. If they can't make it work profitably within their system, maybe it fits better somewhere else. It's pretty frank admission.
Okay, but on the flip side, the zero sugar stuff is still booming. They even give a shout out to Diet Coke.
Yeah, that was interesting. Coke Zero and Diet Coke together are now a mid-teens percentage of their total soft drink volume. And Diet Coke, remember how it was declining for like a decade?
Yeah, it seemed like it was fading.
Well, it's stabilized and is actually growing again, alongside Coke Zero Sugar, which just keeps powering ahead. They put it down to smart marketing and innovation, finding ways to connect with consumers again.
Okay, now for arguably the most fascinating bit, looking ahead. The impact of those GLP-1 weight loss drugs. Investors wanted data. What are people on these drugs actually drinking?
The data they shared was really striking, and it seems to confirm a lot of suspicions. People on GLP-1s tend to drink fewer full sugar sodas, no surprise there.
Right.
But crucially, they tend to drink more diet sodas, more hydration products like water and sports drinks, and actually more coffee too.
Interesting. But the biggest jump they saw was
Protein. A big shift towards protein drinks. This is huge validation for their big bet on Fairlife and Core Power.
which perfectly explains why they gave that update on building more factories for Fairlife.
Exactly. Demand for Fairlife is Apparently off the charts. They literally can't make enough. It's on allocation for retailers. So that new factory in upstate New York is critical. It's on track, they said, and should start ramping up production through 2026.
And how much capacity does that add?
About 30% more potential volume for Fairlife. That's a massive increase, aimed at finally getting the product fully available.
30% is huge. And it's not just a U.S. thing, is it? They mentioned using what they learned with Fairlife internationally, like with Santa Clara in Mexico.
Right. International dairy is tricky, lots of local regulations and protections, but they took the playbook from the U.S., applied it to Santa Clara in Mexico, and boom, volume up 13% in Q3, now the #1 value-added dairy brand there. It shows this protein push is becoming a global strategy.
Okay, so let's try to tie this all together. If you boil down that whole Q&A session, what are the main takeaways for you?
I think 3 big things jump out. First, execution is king right now. Their success is coming from internal efforts, not just relying on the market to lift them. Second, that massive refranchising project is almost done, freeing up focus and capital.
And third,
Third, that huge investment in protein is clearly validated by consumer trends like GLP-1 use, and they're backing it up with serious capacity expansion. That 30% boost is coming soon.
and connecting that back to the structure piece, they talked about finding partners with skill and will, like they did successfully in Latin America for years. Now that's the model everywhere, like India and Africa, building a system for the long haul.
Yeah, exactly. Which brings us to a final thought, maybe for you, the listener, to chew on. We see this clear data. GLP-1 users shifting hard towards protein and hydration. We see the company adding 30% more protein capacity in 2026.
So the question is, how big a deal is that capacity boost, really? Is it just catching up with current demand for Fairlife? Or is this the moment they really start redefining themselves more towards health and wellness for the long term? What's the strategic significance of that 30%?
What stands out to you? Something to think about.
We'll leave it there for this deep dive. Thanks for joining us.